everyone from across our beautiful continent, our beautiful country, and our lovely cities. I would like to welcome you all to our webinar for this week, for this month. And I hope this is your highlight or one of your many highlights for the week. On that note, I would really like to welcome you to today's webinar, which is quick tips on helping small business clients interpret their financial accounts and create a working budget. And before we get started, I really want to welcome our lovely colleagues who are here. And I'm excited that CEDA and IBASA and the EPI are here as a team, as a group of different organizations collaborating, anything as a government organization or around these results at the moment. Is there anything you're going to give us some insight, which is the best one? What are your thoughts?
You know, it was interesting to see that the market value of the business ranked very low.
Mm-hmm.
And one comes back and say 90% of our small business do not do financial accounts, to a point where they only come into accountants and people like ourselves at a time when the users of financial information need them. Either SARS wants something, either the bank wants something. So the value of the business to them is something which they often not do when they're supposed to, because 90% of them do not have financial statements. And you find that they walk in here without financial statements. And those who have, then obviously they will start doing your gross profit margins and all those items which are given. But 90% of the people who have answered, the market value of the business is not done in most of the time. And some of them, until the end of the businesses, they don't even start or even do anything around it. So basically, that is the first thing which comes up, is that why the market value of the business is not done is because our people do not value services. They would rather go and into the hard business, the core business, and not focus on things like marketing, things like business planning, things like financial management. So basically, we find ourselves with a situation where we've got people who come in and have a problem as far as their financial information. So that is the basis of what I see on all this. So I'm not surprised why the market value of the business is where it is. It is because most of us do not have the records to do that. And most of us do not track our business. Most of us sit back and expect that the business will just generate money. And at the end of the day, hence my idea of the free cash flow. The free cash flow becomes critical because we just take every little cent we find, we take it away from the business. That is the problem which creates a problem for most of the businesses. You walk into a store, you pull out your business card, you buy groceries. You walk into the store, you pull out your business card, you pay for lunch with your friend or your family or whoever you're dining with. So basically, those are the critical problems we're having. No financial records for most of our businesses.
Wow. Now, thank you very much, Abel. You've really already answered our pattern of behavior to the questions that you decided to ask us. And I really am so happy that you're here. And I'm grateful that you're here with all your experience and you're going to give us real tools and understanding why we don't appreciate the market value, the one at the bottom that was only 6%, how we can move that up. So I hand over to you and thank you very much.
Thank you once more. Let me try and share the screen. I'm still disabled. But having said that, as we go on, we'll realize that some of the things which are a big problem to our businesses, it's the lack of information. Some of our, the thing which we find as accountants or keepers, somebody brings something which I would call a box file. And in that box file, you've got slips for personal expenses. The first question is it complete or not complete? Those are the basic questions. I'm still trying to share the screen here.
I apologize on that. We're making you co-host.
But having said that, is that we find that most of our businesses not keep proper set of accounts. 90% of the time, the risk they find themselves in is that they cannot comply with most of the things they're supposed to be doing. Did I share a wrong one? It looks like.
No worries.
Nothing has come up as yet. There we are. I'm sharing that one.
Great, thank you.
Can you see it?
Perfect, perfect. Go ahead, it's over to you, but Abel.
Let me go. Basically, what we'll be doing is that I'll be looking at a quick overview on reporting. Then later, quickly look at public interest score, which most people don't even understand what that is. And the next item, which I would want to say, the users of financial statements and the terminology used on annual financial statements. And then we'll go into the ratios and we'll go into the creating of budget, and thereafter we go into conclusion. So basically, the work which was given to me was too much in that if I had to do everything to cover the whole topic, I would be here for the next 2 days trying to maneuver around the information which we've got. Having said that, let's see what we've got. Reporting. There are two areas of reporting, where the first one is compilation reports, and the second one is assurance reports. On compilation, here you find somebody comes and say, give me a financial statement, and in this financial statement, there is no commitment. The accountant, the bookkeeper, the auditor, or anyone who presented that does not give any assurance to anyone. Just say, I have compiled this information. And generally, when you get compilation reports, is that there is lots of monkeys included in there. So no one is prepared to come in and make the assurance. And the second one is the assurance reports. On the assurance report, when you get your financial statements, there will be a report by your accountant, by your independent reviewer, or by your auditor. And there are two of them. First one is what we call a limited level. And I normally call it a negative assurance. And the other one is the high level, which I call it a positive. And one would say, why is one negative, why is the other positive? The limited assurance, you'll see it will say to you, we have no reason to believe that the financial statements do not fairly present. It does not say the financial statement present. And the second one, which is the high level, normally, which is the positive, actually tells you exactly. The first one says to you, if it's looking at a person, it says, I have no reason to believe that this is a person. And the other side of it is that the high level says this is a person. So basically, if you look at those two, the other one is not completely positive, but both of them are giving you some level of assurance. Then you go to the what determines which assurance do you need? Is it limited or high level? The thing which comes in there, it's the public interest. And 90% of the businesses, I think we're speaking to here, are those businesses where their public interest scores qualifies for what we call a limited level of. And one would say, what are those? How do you calculate the PIS, which is your public interest score? You use 1 point for every employee and 1 point for every 1 million rand. And we use 1 point for every 1 million rand of turnover in the business, and 1 point for every individual who, at the end of the financial period, has a beneficiary interest in the entity. That one, let me explain what we mean by that. We mean a situation like where we find an insurance company, where you've got people who put their monies into that particular company. Those people are counted to say that how many are they? If they meet a particular level, then you need to go back and do what we call a high level or limited level, depending on the calculation. And we are not going to go into the calculation and say, is it 100, your PIS, or is it whatever the number is for the purposes of this particular exercise which we're looking at today. Then we come in and say, as far as the reports are concerned, there will be an independent review, and the independent review is what we call a limited level assurance. And an audit is the one where we call it a high level assurance. So basically, once you've got those, you're finding yourself at a situation where you can say, the kind of business you're running, do you need a limited level assurance or do you need a high level assurance? With the new Companies Act 2008 as amended, you'll realize that not every company must do an audit. And resulting from that is that you must determine to say, what is your PIS or your public interest score? And on the basis of the public interest score, there will be a particular level at which you're supposed to come in with. So basically, that would be the information. Quickly, who is supposed to use the financial statements? We've got shareholders, potential investors. When we talk about shareholders in a small business, it will be the owner of the business, and it will be a partner if it's a partnership. And you'll have suppliers and lenders. Those people who give you money will be interested in your financial statements. And also management. Management, I've put it at the bottom, but it's supposed to be on top, because when you speak to management, management are the ones who are supposed to be on daily basis, have the information on regular basis. And other people will be your bankers, your financial institutions, employees, professional advisors to the investor, financial journalists, and commentators. When you look at this particular slide, it is very critical to say to yourself, you do not try and find the financial information at the time when they are needed. You're supposed to have them on regular basis so that you are able to go to the next level where you are able to understand what are those financial statements. In the olden terminology, we used to call it a balance sheet. We still do call it a balance sheet, but also the new terminology says is a statement of financial position. When you find a financial statements, some of us who have not been exposed to this level, you'd be looking for the balance sheet, whilst the accountant or your auditor has used statement of financial position. That is the same, one and the same thing as it comes up. And the next item would be your income statement. Other people would call it statement of comprehensive income. And the last one, which is the old one, which is known as the source and application of funds, which I think most of you might not even remember the source and app. Currently, we're using statement of cash flow information. Basically, that is a new terminology, so that when you look at financial statements, and if you're one of those people who have started many years ago, you'll come back and appreciate all what is speaking to. Then on our ratios, which is the main thing, or the main theme for us today, we're going to be talking to the profitability ratios, the liquidity ratio, efficiency ratios, financial position, and cash flow ratios. Only free cash flow we'll be looking at. And you'll realize that if we had to take all the ratios, like I indicated at the beginning, it will take us a very long time. And here we come in and say, what are those ratios which are critical and very necessary? You'll realize that when you go to other entities, you may even find other new ratios, maybe which you have not studied when you're at school. Things like when you go to a medical facility, there'll be something like PPD, there'll be something like length of stay. Those will be the ratios which speaks to those particular entities, which we're not going to look at the moment, because we're looking at small businesses, and within small businesses, we look at a few of the ratios. And the ratios which we're starting with is the gross profit margin. In one of the questions we said, which in the order of ranking, which is the three most important. The gross profit margin normally, when we are taught, becomes the first ratio which we are taught. And sometimes we underrate this particular ratio. This is the most important ratio because it helps you determine the basic pricing accuracy. Actually also help you to monitor the cost of sale. It also helps you to detect the cost changes, the influences on sales mix. It helps you to monitor stock, and it is very useful but underrated, like I have indicated earlier on. And you'll realize that if your gross profit is not properly set, the business can collapse. Quickly, some years ago, I had an old man who came to me and he had a problem. The problem was that his pricing was completely flawed. What he did is that he was buying his goods from Macro. He went to Macro, bought the goods, and just put a percentage markup. And I can tell you that his prices were much lower than any other person in the township. But at the end of the day, that business had to close. And the reason why it had to close is because his percentage markup was not a scientific calculation. There was no reason why he had put that particular percentage. In fact, there were lots of other costs associated with buying, which were not put into place or were not looked into when the pricing was moved. Basically, if the old man was using a gross profit margin or gross profit percentage ratio, could have realized that the percentage which is putting compared to the other people around him, that he was not making himself a favor. And the calculation thereof, we normally say it's your gross profit divided by sales. And you know that your gross profit is what would say your sales minus the cost of sales, then you come to a. So basically, this ratio is one of the ratios. I can tell you it is the ratio which, like I'm saying, it is underrated, but is the most important ratio you can think about, because with this particular ratio, you are able to look at the information which is sitting with you. You are able to come back and say to yourself, the profitability is not put in correct. This is the beginning of all the correct or the wrong things in the business. If your gross profit margin is flawed, you already are out of business, because where your business starts. The business cannot recover if your pricing. So it becomes critical that the pricing is correct so that you are able to go on with the others as easily and as profitably as you can. Then the next phase is your operating profit margin. And here you'll realize that beyond your gross profit effect, you see your efficiency in how you look at your expenses. You see your sensitivity analysis around your sales level, depending on what levels you're selling, what are the operational expenses which comes into play, and also in your fixed cost. You cannot decide to keep a lot of stock and have maybe a lot of storage space when you're having a particular sales level. So those are critical, and they can actually help you to determine how you operate, because in having a number of your operating expenses play a critical role in getting you to your profit level. So your profit margin will actually tell you if you're making profit or you're not making profit. And that one, it's normally known as your profit before interest and tax divided by sales. And traditionally in the olden days, we used to say your net profit divided by sales. That would be your net profit margin or your operating profit. Depending on the kind of terminology you use, profit before interest and tax, for those who are running businesses where there's interest in the business and where there is obviously taxation, taxation would be a factor in all our businesses, because as soon as you start making a profit beyond R1, you must start to know that you are supposed to be putting money aside for paying the receiver of revenue. So basically, This is the second ratio. And one would come in and say, your profitability ratios, if you sit and go and do all the other ratios and leave out your profitability ratios, then your business is dead, because you do not even know if you're making money or not making money. Critically, you need to know what you're making as you do your business. And the other ratio which is necessary as well is the return on capital employed. And this one we calculated by saying the profit before interest and tax over your capital employed. So basically, to me, this one actually tells you if you need to invest in the business or not. One would say, why do I say that? Let's suppose you're getting 2% out of the business when you do your calculation. And if the bank can give you 5%, why waste your time, put your money into this business which gives you 2%, when you can take it and put it into the bank and you get a 5%. So basically, this ratio as well, it's also important to know what you've put in, what are the outcomes as a result of what you've put. And this can actually help you in benchmarking the cost of borrowing to say, how much is the cost of borrowing? How much is the percentages or the rate which is given by similar entities in the business? So it becomes critical to know what kinds of returns are you getting out of business, because if the returns are not correct, then you are not supposed to be running a business. And the return on your business become critical again. Going back to what I've said earlier on to say that most of our businesses do not even prepare financial records. I'm not sure how they're going to be calculating this. And most of the practitioners around who are in the room at the moment would agree with me that most times, if they are financial planners, they would go to a business and say, we want to assist you with this particular item. And the only item they'll say, no, I'm going to see my accountant to give me the financial statement. That's not how you do your business. Because if you do your business that way, it means you are at a point where you're going to lose before you even start. You need to know what your return on capital employed is. Then the next ratio, which is of interest as well, is the net asset turnover. Net asset turnover actually helps you to the efficiency in generating the sales. How much sales are you making out of what capital you put in? So your sales, it will be your total sales or turnover divided by your net asset. And once you do that, then you actually say to yourself, the amount of assets I'm putting onto the business, is it sufficient to run the business properly? That actually tell you the amount of money you're utilizing to help you grow the business. And that calculation can also be done separately on your non-current assets and on your current assets. You can have a split to say that what is my net current asset ratio or my net non-current asset ratio. So you can do that particular calculation as well. So basically, that calculation is also important. But going back to what I had said earlier on, it is critical to say that you must have your goals. That's the first thing. And the second thing is that, which is critical as well, is the fact that you must make certain that your profitability ratios are calculated. Let's see what happens here. If you say you take your profit margin and your asset turnover, what do we see? You multiply that red axis to multiplication. Then you've got these formulas for the T. It's profit before interest and tax divided by turnover, multiplied by turnover, divided by capital employed. And obviously, I think most of us know that when you've got something like that, you can cancel the turnover and cancel the turnover. Then the solution is profit before interest and tax over capital employed. And for those who have seen the formulas earlier on, you'll know that this is return on capital employed. Basically, now you can see the relationship between profit margin, asset turnover, and also your return on capital employed. Basically, now you can actually see the relationship. And with the relationship, why is it necessary to see this relationship? Because you've got the profit margin on one side and the asset turnover on the other side. Profit margin gives you the quality of goods and services. On your profit on margin, it speaks to the quality of goods and services. And on the asset turnover shows you how much capital you've employed. Basically, the kind of quality of goods speaks to the kind of investment you're putting into the business. Basically, that tells you that in brief, to say that once you've got your business and you're trying to make profits, you need to say to yourself, what kind of quality do I need, and what kind of assets of working capital put into this particular business. So hence you see that relationship. For those who have done accounting one, you'll remember the days when you'd be given a balance sheet in those days with missing numbers and given the ratios. Out of the ratios, you'll be able to calculate back. And this would be one of the things they would give you. Somebody would give you a few items, such as your return on capital employed is X amount, and calculate your profit or calculate your sales. On those days, would enjoy using the formulas to do the calculation. But with these little formulas which we're looking at, you actually see on your profitability ratios. Then the next one is your liquidity. Liquidity speaks to the amount of current assets you've got against your current liability. Others would say your payables against your receivables. And normally there are two ratios on liquidity. First one is your current ratio, and the second one is your current acid test ratio. And traditionally, your current ratio, we are happy if it is 2:1, which means if you've got 2 rand of your current assets, 1 rand of your current liability, it means your business is properly geared, it's sitting properly in that it's able to pay off its liabilities in case there would be a shutdown, there will be a call to say that you need to liquidate the business, the issue around solvency, which we did not touch today. Then the next item which you look at is your peak or your acid test ratio. Peak ratio is basically, other people will tell you it's 1:1. Others would go to a point where they'll say, as long as you've got about 70.7 of the liabilities, you're still fine. So basically, those desirable numbers, they are not cast in stone, because depending on the kind of business you've got and the size of the business, your desirable amounts may differ from one entity to another. And you'll realize that in this particular, the difference between the two ratios, the first one, it's your current assets is to current liability. And the second one is your current assets minus stock is to current liability. The second formula, we are saying, let us take away the stock, because we know that the conversion of stock may take a little longer than that is the first thing. And in case of closing the business, you may actually not recover the actual value of your current stock. Hence, in the calculation, we say on your current assets, on your current ratio, you would include that stock. But on your peak ratio or your acid test ratio, you'd exclude that, because you're actually saying what happens if you don't get the full amount. And 90% of the time, the quick ratio normally tests how quickly you can convert all the other assets except stock, because sometimes stock, you might not be able to sell it in case you had to close because of the things which you are working on. So basically, these are the quick asset ratio. Then you come to the next level, which is the efficiency ratios. On the efficiency ratios, you've got your inventory turnover, and side by side are also put the inventory turnover period as well. So why did I do that? It's because I was saying These two ratios, they do exactly the same thing, but they look differently in terms of calculation. The calculation for the inventory turnover ratio, it's your stock divided by cost of sales times 365, your turnover period, your inventory turnover period. Here we're trying to say how many days does it take you to convert stock, whilst your inventory turnover ratio alternative, the alternative one is that the calculation would be your credit sales divided by stock. There you are actually saying what is the how many times can you do your calculation on your stock? How many times do you keep your stock? If it's over the year, if it's 3 times, then it means every 4 months. If it's 6 times, it means every 2 months you're turning over your stock. Basically, those are the two which you'd be looking at when you look at that. Then the next 2 other efficiency ratios are the receivable collection period and the payables collection. And the first one, on the receivable collection period, there we're saying how long does it take you to get the money from the customers? And the other one is how long does it take you to pay your creditors? And one of the things, sometimes it becomes deliberate to have a longer period. For example, if you've got shops where they're selling clothes and they give you cards to pay over 12 months, it means they've accepted that their debtors period will be 12 months. They have accepted that that would be their standard trading policy for them to be able to sell on 12 months. But for small businesses like you and I, the best time you need to look at nothing more than 2 months. If you're selling, the best you can have is your cash. And if you have to have debtors, not more than 2 months. Once you go beyond 2 months, you start having problems. And on the other side, on payables, the longer you take not paying your creditors, you may find yourself not being given credit by the people who are supposed to give you credit. So basically, that becomes critical to say to yourself, on your payables, how do we deal with our payables and how do we deal with our receivables? So basically, these two are very critical in that you don't keep your debtors too long, your receivables too long, because if they are too long, you will not recover. And your creditors, you don't pay over a long period because you may end up not being given credit in whatever you want because you'll be seen to be a terrible person. But one would say if you find those suppliers with deep pockets, they'll be interested in giving you a longer period. And if that happens, take good use of it and don't take the money and put it into the because you'll need them. And the next one is the financial ratios, the debt equity. Here we're sitting and saying, how much of your money are you putting in the business and how much of the money are you getting out of the bank or the lenders or whoever is prepared to give you a loan for the business. And the lower the lesser the debt, the better for yourself because it means you own the business. Because if the other side persists, it means at the end of the day, you do not own the business. Having said that, let me warn and say sometimes it is the make of the business which may decide what kind of a debt equity you need for the business. And different businesses may attract different debt equity ratio. And the next one is the interest cover. Here we're trying to say to ourselves, how much do we cover our interest in terms of our profits which we're making against the interest payable, so that we're saying to ourselves, is the interest taking the whole of our profits, or do we have room after we've paid our interest? Because if the interest takes the rest of the profit, then what are you making at the end of the day? Because you would not have anything to show at the end of the day because there would be nothing remaining. And the next item is Small business. As small business, we know that we need money at all times. And 90% of the time, why do we need money? It's because there will be what we would call unstructured salaries. And the next item is personal expenses regularly paid by the business. Here, I'm trying to warn all of you to say that if you're running a business, the best you can do for yourself is to say to your business, I need 50,000 per month, or I need 20,000 per month, or 10,000 per month, depending on your needs. If the business cannot pay you what you need, then the business is going to die because you're going to draw too much out of the business. Hence, it becomes critical to understand that. And the reason why we had the slide was to put you into a situation where we say, let us show you the next stage where we speak about free cash flow. It becomes necessary to do a calculation on your free cash flow. Before you can do anything for yourself or private consumption, you need to say to yourself, what is free? How much is your free cash flow? And your free cash flow, basically, you can see it out of your cash flow statement. All the three elements of the cash flow statement would actually tell you how much free cash flow exists in the business. And once you know how much the free cash flow is in the business, you don't just wake up tomorrow morning and take the whole of it. Next thing you need to do is to say to yourself, on an annual basis, let's suppose you need extra cash. You need to say to yourself, what is the percentage of cash you're going to take out of the business? And you can decide on doing that. I was fortunate to be a director in a company where we're calculating incentives for the key management of the business. And one of the things which was put into the picture was to say that the dividends will be paid a percentage of the of the free cash flow. So basically, what we're saying to everyone, we can give you an incentive, but that incentive must be a percentage in a year where the free cash flow does not permit. That incentive will not be there. Basically, this is one of the most important things in your business. So as a small business, you need to get to a point where you sit and say, how much is my free cash flow? How do I calculate my free cash flow? And once you've calculated the free cash flow, you are able to say, what is the percentage which I can take on an annual basis? If you come to a year where there's a negative free cash flow, then you sit back and say to yourself, do I need to pump in some more money into the business, or do I need to sit back and say, no, can't take any money out of the business? And you can utilize it when you want to pay dividends, purchase shares, and other services or other demands. But at the same time, let me also continue to say there is another element called free cash flow to equity. On this one, when you do the calculation on this one, you exclude the debt. It means if there is money coming out, which we received coming as a result of debt, that particular money would not be part of. And a quick calculation which I would want to show you is that let's suppose we say calculate the free cash flow on equity. Let's suppose there was 100 million cash operations and there was 60 million on capital expenditures, 10 million on borrowing, which you receive from borrowing. Basically, then your free cash flow on equity will be 40. You only take the two items. But if you want to calculate your free cash flow, then it will be 50 because even that 10 which came into the picture comes into the definition. So basically, that element becomes critical. And I know that we're going to have some little bit of questions around it, and we will come back and speak. The area which is difficult for every business is creating a budget. Creating a budget, it is not the easiest of all. The only time when you have an easy situation is when you've been running a business for some time. Then you are able to say you can benchmark based on the activities from the previous period. And once you can do that, then you can prepare a budget using the operational budget, where you create your sales budget and your expenditure budget. Basically, that would be your income statement budget, where you say, what are you expecting? What are the expenses? Also, there will be what we call the CapEx budget, and the capital budget will be the budget for all the capital you want to buy or have in the business. And the most important one, again, is your cash flow budget. There is no way in which you start a financial year and do not know when you're going to need bank overdrafts. Because if there's a time when you're going to be under, you have to plan for it when you've got money. If you go to the bank when you have no money and you say to them you want an overdraft, it takes longer to get money. But if you're sitting here today and you've got 100,000 in the bank account, and you say to the bank, I need an overdraft of 100,000, it's easy for them to give you an overdraft, because you might have anticipated that in 3-4 months down the line, you would need that particular overdraft because of the kind of operations you're going to have. So your cash flow budgets are very, very critical. To me, because I'm running a small business, I've learned to say that everything which speaks to cash becomes the most important for a small business, because this is the thing which makes you tick at the end of the day. Because you need to understand how much cash you've got, how much cash you can spend, how much cash you can put aside for yourself. Then the next area, you may need to understand kinds of budgets. There could be a master budget, and the master budget is made up of a number of smaller budgets in it, where you've got your operating budget, your cash budget, your labor budget, your revenue budget, and your fixed costs. Basically, with your master budget, we actually are saying there will be different kind of budgets which you need to look into. Because of time, we are not able to create all those budgets and have a session like we are in a class, so that we are able to show you all these particular. But I can tell you, once you sit and start looking at this, or you're interested in understanding or creating any of these budgets, we can, as accountants, and I've realized that people are coming from different areas, and from the areas where you are, there will be service providers who can provide you with the information which we have just shown to you now. In conclusion, the ability to continue using the ratios can safeguard the operations of your business. If you've got your ratios, they can actually safeguard you, because if you're now seeing a negative GP or a GP which is dropping, then you know that it's time to correct it. How do you correct it? Either you increase your sales or you change your suppliers to decrease your cost. What I'm saying is that it becomes critical to understand whatever you're supposed to be doing at any given time. And creating a budget, it's a good guide for every business. You don't wake up and think that your business will go if you don't have your budget. To your point, other people create a budget, which is their operational budget, and sometimes they create what they will call it a stretch budget. With a stretch budget, they say to themselves, we want to increase maybe beyond a normal increase. Let's have another 20% as our stretch, but we're able to find something better. And lastly, I would say monitoring of your cash in the business becomes critical, and monitoring of every activity in the business becomes critical. And by that, thank you very much for giving me the opportunity to share with you. And I hope we've made a good impact on you. Let's see how we answer the questions and how we go forward. Thank you very much.
Thank you, Abel, as you stop the share, and we're going to now engage and interact as you're going through that. That was so insightful, and I'm looking forward to see if there are any questions or thoughts that are coming out. But while that's going, I have a couple of questions as well, but Abel, as we are both now going to be sitting next to each other on the screen. And then all my other colleagues soon will also share some insights. But my question around the ratio, right? Which is the best? I don't know if it's a right question, but it's my question. Which is the best ratio? Where's a good place to start? If you had to look at the ratio ones, which ones are the important ones to work on? I don't know if that's a fair question. Because there's quite a bit there.
It is a fair question. And the fair question is answered by a fair answer. And the fair answer is that everything starts with your sales and starts with your gross profit. So basically, that first ratio, which is your GP percentage ratio, becomes very critical, because if it's wrong, you can't correct anything. You can't correct it. You can't have too much injection in the business because your GP is incorrect. If your GP is incorrect and you're making losses as a result of it, the only way to change it is to change that GP percentage. And like I'm saying, it's the first ratio which we were taught when we were at school. I can tell you, it is the ratio which is very, very important. Your interest cover does not matter until you've corrected your gross profit. Because if your gross profit is correct, all the other things which come thereafter, they become a second thought on it.
And then you mentioned something around the market one. There was, because that was the least, the market value of the business. Why is that important as a small business? How, like what? Yeah.
The reason why it is important is because you need to know what you've got. You know, you can't be sitting running a business. You don't know if this business is 20,000 or 100,000 or a million. You need to know what kind of value you've got, because the kind of value will speak to the policy you take around it, the insurance you may need to take, because at some point for a business, you may need to take insurance. How do you take insurance if you don't even know what a business value is? You don't even know what kind of third-party challenges you may have, because you don't even know the size of your business. It becomes critical to understand your business and know what size the business is there. Remember, I said the reason why that is ranking last is because 90% of our businesses do not have books. That much I can tell you. In fact, if you can walk into my office one of the days and I show you some of the things we receive to prepare financial statements, you'll be shocked, because we end up working more about the bank statements than the actual records they've got, because the records they've got, the kind of documents they present, some of them, one, they're not complete. Two, they are very suspect in terms of what they are. Three, they are just thrown into a box or something like that. So you can't find something credible. 90% of them, you don't find something credible.
Sure.
And our strive as practitioners is to say to them, why can't you, as you start your business, make a relationship with your accountant bookkeeper? Every month you take your documents and put them with him, not to try and scrape them out when they are needed. Are you still there? It looks like she's...
Yes, I think it's like Tobeka is not here. Mangolele, there's another question from the floor. And the question is, what are the methods you use to calculate the value of a small business?
Good question. You know, there are about 5 valuation methods. There would be a present value evaluation. There would be an intrinsic value method. There are a number of methods. The best you can do, firstly, you need to understand what business you're running. If you're running a property business, it means your asset-based valuation would be much better for you. If you're running a business where you are looking at profitability, then your profit, let's say when I say profitability, I'm talking about when you you're not in a property business, and you are able to check on your net present value of the business. Your net present value method would be appropriate. So basically, the kind or the method which needs to be used will be determined on the kind of business you've got. Like I indicated, if it's a property business, your asset valuation method would be deal method. But at most times we use the net asset. Sometimes you may need to do a net asset valuation. Sometimes I can't have a straight answer unless we're sitting with a business X. With a business X, then we look into the kind of a business and say, on the basis of this business, this is the valuation method we're putting forward for the business. But there are about 5 valuation methods. There's a question which says, how can ratio analysis help in drafting projections for a small business? Firstly, if you know the kind of, for example, let's suppose you've got a business with a GP of 80%. It means going forward on your projections, it means your gross profit must maintain that 30%. So it means it can actually help you to do your projections. And also, it can even tell you what kind of assets you have, because you may actually say to yourself, what kind of asset turnover ratio do you need? Then at some point you may need to withdraw if you find that you've got too much capital compared to the asset. So basically, the ratios are able to help you draft your projections, because you need to know how much cash do you need. Let's suppose you're looking at your liquidity ratios, and you're sitting with 2 million in the bank, but your liabilities are 20,000. Why keep 2 million when your liabilities are 20,000? So you can actually say to yourself, on the basis of those ratios, you're now sitting with extra cash which you don't need for the purposes of paying these assets. Maybe you need it to buy stock. All these, once you know them, you are able to factor the kind of cash you need in the business.
Great, thank you, Sis Bongi. You answered that one question, right? I'm assuming that's the one you answered.
Yeah.
From Dev. Dev, I hope you're happy with that. And also as well now in Atlanta. Thank you very much. Any other questions? We still have about 8 minutes, but to just talk to something for some of you on how to keep track or understand, register, or what webinars we have, we'll give you some more information at the end of this session on how to keep track on what our next webinars are. There's another conversation here that Terence shared. He says, why not start your budget with a profit figure? The profit figure is the amount that allows 50% of reinvestment, 30% of dividends, the extra you need, and the last 20% to invest into your community. Interesting. Any thoughts on that, Abel?
Yeah. In fact, when he says he wants to start with profit, that's exactly where I want to start. The reason why I'm saying it's exactly where I want to start. I don't want to start a business which I'm going to struggle to have money coming into the business. That's exactly what I'm trying to say. But there may be a situation where you may need to start a business where the starting point for the next few years, there may be losses. And there may be a reason why you go through that kind of a business. For example, let's suppose you want to start a hotel business. A hotel business, you're not going to get money day one, because the occupancy would not be there day one. You'll find that in the first few years, people don't know your business. Year 2, then they start. Year 3, then post year 3, year 4, then you can continue and have a profitable business. So basically, depending on the kind of business, you may find different starting point. But starting with a profit, voila, I'd love to start that business.
Yes, wouldn't we all? And I think also that whole 20% investing into the community will always depend, of course, on what your cash flow looks like, if your financials allow you to be able to do that. And even better if you have a business that automatically contributes to community development. For some businesses can do that, but yeah. And if you even get dividends, because I think the language around dividends, doesn't it also depends on the size of your business where you can start thinking that way?
Remember, I spoke of free cash flow. Once you've calculated your free cash flow, there could be a 20% on community. Let's suppose you are one like the person who spoke about free cash flow community. There could be a 10% which you can invest onto your managers. There could be a particular person. So basically, out of all this, you are able to say, what can you spend? On the basis of the fact that you say to yourself, what is my free cash flow? And what are the percentages of the split? And how much do I retain out of my free cash flow? All those factors are playing a critical role. Free cash flow becomes your point of entry in trying to distribute money for whatever you want to distribute for.
And then I guess that kind of connects about creating a budget. Right. So there was something you said that was very important that kind of hit close, is that my next question is, what's the best practice to look at your budget? Yeah. Because now if I look at my budget and I need an overdraft because I'm able to see where my clients are, how many clients I have, when they're going to start paying me. And then I know, oh, it's going to take a while, but at least I have 50,000, 100,000. That's when I should ask for the overdraft, yeah, versus asking for the overdraft later. Just let's, I think there's some dots there that I think we might forget to connect.
Yeah. Remember I said to you, planning becomes critical. Budget is a plan. In simplest term, a budget is a financial plan. So if you do your budget and you do your budget properly, one of the things is that you think to yourself, for the next coming year, will I find myself at a point where I am under or below in terms of my cash resources? And if that happens, you realize that in 5 months' time, you need money. It is better to go and look for it now when you've got 200,000 and say to the bank, give me an overdraft of 100,000. They'll give it to you very quickly. But don't go to them when you already you can't even pay. Fortunately, these days there is not bouncing of checks because you no longer have checks. So at the point where account is sitting at a point where you do not have sufficient to pay your creditors, that time you go to the bank. They said, how much do you have in the bank? Says, I've got 2,000 rands. They said, no, you are too risky. So what I'm trying to say is that if you can plan it earlier and know that in February next year, I'll need an overdraft of 50,000. Go now when you're having 200,000 in the bank account. It will be easy. No questions asked. I can tell you this much. The bank manager will love you, say, oh, you need money. But I see you've got money. Said, no, I just want to have some buffer. They'll give it to you. Don't go to them when you're
in desperate need. Awesome. Thank you for that insight. Last, there's a couple of questions in the Q&A, and we'll end with these two. The bottom, they're coming up now. Okay, what is the best system software you could recommend to assist us with all financial reporting, ratio analysis, and budgets to assist owners in making decisions, in the decision making?
Wow.
And then, okay, while you think, let me read the next one and see which one you want to answer. And then the next one is it recommended that directors have loan accounts?
Yeah, let me start with the last one, loan accounts. Yes, you'll have loan accounts, but you must restrict them.
Okay.
And say you're not going to have a loan beyond a particular amount. It's like a loan account is an overdraft. So you're sitting this side as the business and say, you, the owner of the business, I can only give you a loan to the tune of 50,000, not more than that. unless if you're talking about a loan account where sitting in credit in the business will say yes anytime because you'll be investing into the business. But when you're talking about the loan account, I'm thinking that we're thinking about the loan account on an adverse side of it, where you're saying you want to go and borrow from the business. If you want to go and borrow from the business, firstly, the business must establish how much is available for borrowing. Free cash flow plays a critical role. And the other one is the best system for software to do the calculations. I am a Microsoft proponent, where you create your own ratios, because sometimes within a business there may be ratios which you can't generate out of a paid software, but you can create so many ratios for yourself. I happen to have an association or a relationship with a hospital group, and in that hospital group, we're using Excel, and we create our own ratios. But some of the ratios we need, you don't get them out of buying a software. You can get the standard ratios like we have spoken to today, but there may be ratios where you start saying, what is my salaries to turnover ratio? Those kind of ratios, they're not easily given by standard software. So what I'm trying to say is that your Word, your Excel may be the best thing to use. Yeah, for small business, because if you want pre-packaged, you pay a lot of money for it, and you might not have the money to pay the kind of money for the softwares which can give you those best ratios. Best thing you do, create good of Excel table, and you can work much better that way.
Great, thank you very much. And I would also like to invite maybe my colleagues who might want to share or say something. Sisbongi Derek, please feel free to unmute as we are coming to nearly the end, just to give you guys time. And I guess there is that one last question. I don't know if I should put it to you, but Abel, or if Sisbongi wants to respond to it. And the last question is, in a hyperinflation environment, is it okay to overinvest and ensure divestiture rather than the high liquidity ratio and lose on time value? I'm looking at speculative scenarios. I don't know if Sisbongi or you want to talk to that.
Yeah, I think the question comes in, remember what happened 2 years ago when COVID hit us, and shares, all of them plummeted. And some people at the time bought shares and they've made huge of profits. And if you have the appetite for it, so be it. Because at the time when COVID hits, we're all thinking we at the end of life, and the mask was the next thing, and it was the vaccine, and people are dying left, right, and center. I remember there was a day when in two WhatsApp groups there were 3 deaths each, so you can actually realize that there were too many. At the moment, you go for months without hearing that there is somebody who has died in the groups in which we are. In 2 groups, it was just crazy. But at the time, for business purposes, a lot of business which went under. But if you had money at the time and invested, you'd be smiling at the moment. You go and look at the number of shares April 2020, and you look at their values now. Lots of profits have been generated. But risk appetite, that would be the answer.
Great. Thank you very much, Buti. And also, I mean, petrol was one of those where it was cents then, and now look at where we're at. Anyway, let's move on swiftly from that. And I'm not sure if Sisbonge wants to say something. And while I just really thank you very much, Abel, for spending so much time and sharing your insight and your experience in the space. And it shows with all the experience you have, and being really involved and part of the accounting and tax practitioner industry as a tax practitioner yourself, and being on these wonderful boards of the Alexandra Health Center and a lecturer, of course, of Vista University and the group CEO of Fabcos. So we've just had an amazing experience firsthand, and you've heard it from the horse's mouth. And on that note,
by the way, sis,
yes,
there's a hospital group called Butsamed. Do you know Butsamed?
No. Do you know Sisbonge? Let's unmute you and come in and save me. Yeah.
It's a black.
No, I don't know. I don't know.
Okay, we'll talk about it off air.
No, say it. Finish it off. What about the hospital?
Hospital group is owned by black entities. Okay. And it's in, there's one in Cape Town, there's two in the Free State, there's one here in Johannesburg, there's two in KZN, and there's one at Lowveld. So basically it's a big black business coming up.
Wonderful.
I am a director in one of the hospitals, and I chair the human resource committee as well.
Okay, wonderful. Thank you.
Yeah,
we look forward to being in one of those hospitals for whatever purpose that we need.
Please find out where it is and support.
Great. Thank you, Abel. Sisbonge and Derek, any close insights and thoughts as we conclude?
Yeah, from me, it's just to say thank you to Mr. Abel for a detailed presentation. I think it was something that you would follow from the beginning to the end. But I believe that there is a need for us to have you back, especially to unpack the share side of things, especially on how, as practitioners, we can also diversify into owning these shares. Like you're saying, that there's been a huge growth in that space. And I believe that this growth cannot measure to the growth of small businesses. In as much as small businesses struggle, but the growth at a high level, high end, it's still there. So maybe it's one subject that we can look at where you can come back and assist in terms of unpacking, such that small businesses we may not necessarily rely on borrowing money, but we can also cash into some of this investment that you spoke about. And thank you very much. And thanks to everybody for coming along and for being here today. We know that the load shedding has affected in terms of the numbers, but we appreciate having made your time to be with us today. And we are looking forward to having you in the future webinars. And please visit our website, IBASA, and you'll be able to get information about how to become a member, but also how to be involved in the ecosystem of small businesses. Thank you very much. And thanks once again to CEDA and to EPI, our partners, for making this successful once more. Thank you.
Great. Thank you very much. But Derek, over to you, Sisbonge.
Thank you, Thobeka. Once more, hello to other colleagues. And there's a request on the chat box already, Mangolele, to invite you to our biz clinics. I think, yeah, it just demonstrates how appreciative people are. And I would like to also say, this information is not just for the practitioners to assist or to support small businesses, but let's remember that this information, we can also use it in our own businesses because we are also small businesses. So in that word, I would like to say thank you very much for making the time to come and attend these webinars. Continuous professional development is very key. And this is the core of this partnership, which
Mm-hmm.
is the training and capacity building of practitioners. Thank you. Until next time.
Thank you very much, Sis Bongi. I couldn't have said it better. And on that note, there's a lovely link for our next clinic that we'll be having. We have every first Friday of the month. So please click there. And for those of you who don't know when we have our sessions, you have a couple of options. Follow CEDA, follow IBASA, follow the EPI, so that you can see the adverts and us marketing and branding for our next webinar. And our next webinar will be about CRM tools to build trust relationships and deliver a steady stream of new clients. And this is important because if your steady stream of new clients are there, that impacts your cash flow, your balance sheet and everything, which then allows you to make good budget choices. So it's all interlinked. It's not in weird silos and there's no connection. Thank you very much, Ryan, for that and putting it in the chat. And as he stops the share, I really, as usual, want to thank everyone for coming here from across our beautiful country, our beautiful continent. And as well, now we're able for your time. It is really grateful. And hopefully at some point, we will have you at the clinic where you'll have businesses really bring what their challenge is. Thank you very much, everyone. Take care of yourself. Be kind to yourself. Be kind to everyone. And take care of your mental health and your physical health. Goodbye.
Thank you, Thobeka.
Thank you, Sis Bongi.
Goodbye.
Bye-bye. Thank you very much,
Mangolele,
Ryan.
thank you. I'll speak to you later.
Thank you, sis.
Okay, thank you. Thank you.
Thank you.
Okay, so we'll stop.